Hello and welcome to FT Markets here in New York. Janet Yellen has spoken and the bull run has stalled just shy of the 2,000-point barrier for the S&P 500. The question now for investors is, will the 2,000-point level hold, or will it ultimately become just another milestone in what has been a very impressive bull run since 2009 when the S&P was trading below 700? Joining me now to discuss this and the outlook in general for the equity market is Nicole Bullock, who is the FT's equity market correspondent here in New York. Nicole, thanks for joining us.
Thank you.
I suppose the first takeaway from Janet Yellen was that she was actually very balanced in her remarks about the labor market in Jackson Hole, and it would appear that the stock market was actually anticipating a much more dovish message. And so the question really is, how long are we going to sort of stay here just shy of 2,000, do you think?
Well, the S&P 500 has been making new highs for quite some time now. I think it's just that the 2,000 mark is a nice round number, and so that always carries a lot of psychological significance with it. And so coming into the speech, there was a lot of enthusiasm as to whether if she did come out with some more dovish comments, this would be what finally drove the market over that level. So it didn't, as you point out, it didn't really go that way, and the comments were a bit more balanced. So the market's kind of unchanged today, just sort of assessing what the next move could be.
So let's look at some potential catalysts here. What have we got coming up that could potentially push stocks to the 2,000-point area and beyond?
Well, it's really been over the past couple of months kind of a balancing act in the U.S. equity market between earnings and the economy on the one side, and all of these geopolitical flare-ups that we've seen happen around the world. So what we did have, which gave the market a bit of a boost in the last couple of weeks, was that the second quarter earnings reports actually came in better than expected. So that has gotten us to where we are now, which is really just right on the cusp of that 2,000 mark.
So is the risk here that 2,000 ultimately is the top for the market, do you think?
Well, I think it really depends, in terms of how things play out in the next couple of months, in terms of, as I said, if the geopolitical situations worsen around the world, then obviously that could spook investors. And one thing that investors have been telling us is that there's a little bit of a concern in terms of a cascade effect, that selling will beget selling. So something spooks investors, and then you have it feeding on itself, because there is sort of a low-lying anxiety in the market that the bull run is getting a little old.
And we're also seeing a pullback in equity buybacks, for example, which has been a very key supportive area for the market.
The preliminary data for the second quarter show that the total dollar amount of buybacks is a bit lower than it was in the first quarter, which was the peak for this period of buybacks, and I believe the second largest amount ever. So we are seeing a little bit of a pullback there, and there's a lot of questions about how the buyback trend may play out once we get to the end of QE, and now that we have equities much more expensive than they were a couple of years ago when companies started aggressively buying back stock.
So I suppose looking ahead now, we've got the payroll report that comes in the first week of September, which could be a catalyst if we do see strong growth. But then we have the September two-day meeting in the middle of the month by the Federal Reserve, which could perhaps give some of the hawks an opportunity to sort of push for a tougher language. Under that scenario, do you think we could actually see the stock market get above 2,000, but then perhaps run into a bit of some choppy water there?
Well, September does look important because you also have everybody coming back from vacation and a bit more activity in the market.
Higher volumes, more activity.
That's right, because right now we're really in the thick of this we're coming into next week, which runs into a holiday week in the U.S.
Yes.
So this is a period of time when we really consider the slump, the summer slump on Wall Street. So September is
at the beach.
Right, exactly. So September is definitely going to be important. But at the same time, given that we have such low volumes and low activity, you could see the S&P 500 inch above that 2,000 mark, imminently, not today, but in the next couple of days, depending on just what happens in terms of data and as I said, these other things, extraneous factors going on around the world. But I think what will get people really excited is a meaningful push through that 2,000, not just kind of breaching it and then coming back, or breaching it by just a little bit. But you need to see, you know, in order for a break above,
Yes.
a break higher, you need to see a significant move above 2,000. And just the other thing that a lot of people have been telling us is, as far as earnings go, while the earnings have been very strong and in record territory, a lot of that is coming from cost cutting and the effect of buybacks, in that companies are issuing fewer shares than they're buying back. So you're getting a little bit of a punch on EPS. So, you know, some additional EPS growth there. And while revenues have continued to be pretty disappointing. So if we start to see that top line really kick in the subsequent quarters, that would be very supportive of stocks moving higher.
Great, Nicole. Well, I suppose if the Fed does look to raise rates sooner than people expect at the moment, the equity market can live with that if indeed revenues start picking up because the economy is getting stronger. But that all awaits investors when I suppose they get back from the beach and back at their trading desks in early September. Thanks so much.
Thank you.